Hello, everyone. Today, we're diving into a critical topic in Canadian tax law. You see, when one company acquires another, it's far more than just a simple change in ownership. From a tax perspective, it's a massive event known as an acquisition of control. And trust me, if you're not ready for it, it can set off a chain reaction of financial consequences that can be incredibly serious.
So in this explainer, we're going to break down the biggest tax traps that are triggered the very instant that control of a corporation changes hands. Now, it's important to know that these rules exist for a reason. They're primarily designed to prevent companies from being bought solely for their accumulated tax losses. Understanding these rules isn't just academic. It is absolutely key to avoiding a major and often unexpected financial blow.
All right, so here's our roadmap. First, we'll define exactly what an acquisition of control is. Then we're going to look at three of the biggest consequences: the deemed year-end, the harsh rules for capital losses, and the conditional rules for business losses. And then we'll pivot from identifying problems to discussing solutions with some crucial tax planning strategies. So let's start with the most fundamental question. What is the actual tripwire? What specific event does the Canada Revenue Agency look at and say, aha, that's an acquisition of control? Well, as you're about to see, it all comes down to a very clear, very specific legal threshold. The line in the sand is what we call de jure, or legal control. Now, this isn't about who has influence over daily operations. It's about one thing, and one thing only: who holds more than 50% of the voting shares. The second a new person or a new group of people acting together crosses that 50% threshold, an invisible tax clock starts ticking, and this whole cascade of special rules is set in motion. So the moment that control changes hands, the very first domino falls, and it's something called the deemed year-end. This is your first and most immediate administrative hurdle to overcome. The rule itself is simple, and it's absolute. The law says that the corporation's tax year is deemed to end on the day immediately before the acquisition. It's a legal fiction that essentially slams the book shut. And what this does is it instantly creates a new and often very, very short taxation period that requires your immediate attention. And this is where the real-world pressure comes in. This isn't just some minor paperwork. It means you have to finalize all the accounting and file a complete T2 corporate tax return for that new short year. But here's the real kicker. Any taxes owed for that period are now due within just 2 or 3 months. This dramatically accelerates your payment timeline, which is often a complete surprise.
So let's be crystal clear about the bottom line here. This rule forces a company to pay its taxes much, much sooner than it would have otherwise. And that sudden acceleration can put a tremendous strain on a company's cash flow, and it happens right in the middle of a major, often disruptive transition.
Okay, getting an unexpected tax bill early is tough, for sure. But the next consequence we're going to discuss is, frankly, even more severe. We're moving away from administrative deadlines and into a rule that can permanently erase a valuable asset right off your books. Let's talk about the treatment of net capital losses.
The rule here is incredibly stark. There's no gray area. Before an acquisition of control, a company's accumulated net capital losses are a valuable asset. They can be carried forward forever to shelter future capital gains from tax. But the moment after an acquisition of control, they are gone, wiped out. They vanish into thin air, and they can never be used again.
So you might be asking, how does this actually happen? Well, the Income Tax Act forces a deemed disposition. It essentially says that any capital assets that have an unrealized or paper loss are automatically written down to their current fair market value right before the acquisition. This action turns those paper losses into real, crystallized losses in that final short tax year. The problem, of course, is that there's almost never enough capital gains in that short period to absorb them, and so they expire unused.
But, and this is crucial, this very harsh rule comes with a very clever strategic escape hatch. Let's walk through this example. The company owns Property 1, which has an unrealized loss of $30,000. This loss is going to be automatically triggered and it's set to expire. To save it, we look at Property 2, which has an unrealized gain. The corporation can then make a special election to sell Property 2 on paper for $80,000. This move creates a $30,000 capital gain, which perfectly absorbs the $30,000 capital loss. And here's the bonus. The cost base of Property 2 gets bumped up to that $80,000 value, which means less tax will be paid when it's sold for real down the road.
All right, so capital losses face a sudden death. The treatment of non-capital losses, the ones generated from day-to-day business operations, is a little more forgiving. But, and it's a very big but, it comes with a significant condition attached.
The entire key to this rule is found in this specific phrase from the Income Tax Act. Your business losses can survive an acquisition of control, but they become restricted. From that point forward, they can only be used to offset future profits that are generated from, and I quote, the same or a similar business that created those losses in the first place.
Now, this same or similar test is subjective. It's based on the facts. The CRA will look at the whole picture. They'll consider things like the very nature of the business, its assets, where it's located, and even its name. The classic example is this. You couldn't buy a struggling bookstore just for its tax losses and then try to use those losses to shelter profits from your new unrelated software company. The core business has to continue, and there has to be a reasonable expectation of profit.
Okay, so we spent a lot of time looking at these tax traps, but just understanding them is only the first step. The second and far more important step is to use this knowledge to plan ahead. It's about turning these restrictive rules into strategic opportunities.
Which, of course, brings us to the most practical and important question for any business owner, buyer, or seller. If you know these traps are waiting for you, how can you strategically prepare for an acquisition of control to minimize the damage?
Well, this brings us right back to that powerful strategy we touched on earlier for saving those expiring capital losses. It's a very deliberate four-step process. First, you identify an asset that has gained value on paper. Second, before the acquisition, you proactively elect a deemed sale on paper, creating a capital gain. Third, that gain is realized in that final short tax year. And fourth, this newly created gain acts like a sponge, soaking up those capital losses that were about to be wiped out forever.
All of this really highlights a critical point. An acquisition of control isn't just a single transaction that happens on one day and then it's over. It really requires thoughtful, proactive planning beforehand and very careful management afterwards to successfully navigate all these tax risks and truly unlock the full value of the deal.
All right, we have certainly covered a lot of technical ground. So let's take a moment to distill all of this down to the most essential points that every business professional should remember. Here are the 4 crucial takeaways. First, the deemed year-end. This is an immediate administrative headache and, more importantly, a cash flow challenge. Second, capital losses expire. They are the biggest casualty in an acquisition of control. They are permanently lost. Third, business losses are restricted. They can survive, but only if you continue the same or a similar business. And finally, and most importantly, planning is absolutely essential. Because of these rules, proactive strategies aren't just a good idea. They are critical to preserving the value of the corporation.
So in the end, it's best to think of an acquisition of control as a kind of tax reset button. It wipes some of your most valuable tax attributes completely clean, and it severely restricts others. The question for anyone involved in a deal isn't if that button will be pressed. It will be. The real question is, are you, and is the company, prepared for what happens after you press it?